sort of said that the old antitrust textbook doesn't really matter to her anymore.
That's right. Oh, so there's the antitrust aspect, and then there's the regulatory aspect, right? The FDIC and the OCC and the Federal Reserve. You can be guaranteed that Capital One floated this to them before they did this deal, and this deal wouldn't be happening if they didn't get some kind of good vibes from them, right? Now, what's going to happen with the DOJ, the FTC, that is more of a political issue, but people make a lot of hot air about these transactions, and they still get through. And what it really comes down to is the willingness of Capital One to fight for this transaction. And we see in past cases, if you are willing to fight, if you are willing to litigate, you have a good chance of getting it approved.
All right, well, Ben, there you are, at the home of all the regulators in D.C. Are you hearing any kind of murmurings today, following news of this deal, that there is any kind of possible problems in getting this deal specifically through on a regulatory front?
Well, I think that the landscape for bank mergers is quite difficult. It's been difficult since the Biden administration took over. So, I think an interesting thing to remember about this transaction is that it's slated to close in late 2024 or early 2025, which brings in a very big event, which is the presidential election in November. And they may well be counting on a more favorable regulatory environment come January 2025. I agree with Matt that there's, doesn't seem to be an obvious sort of anti-competitive bent to this acquisition, given how small Discover is and how it will continue to exist as a sort of a fourth competitor to its larger peers. But, it's the political environment sort of tends to dictate, and the reaction to bank mergers has been negative for the last couple of years.
Yeah, I want to home in on this point, Ben, that Senator Warren said, reduces competition and raises costs. Because if you look at the landscape right now, is it fair to say that there's this quasi-duopoly that exists with Visa and MasterCard? And by having a stronger Discover or a stronger American Express could actually increase competition?
So I think that's fair. I would caveat that I think American Express is usually the most expensive network, and that's because they have to pay for really attractive rewards for their high spenders to be attracted to their credit cards. So I don't think American Express will ever be sort of the competitor that drives costs down. If anything, they take advantage from their niche to sort of push costs up. But Discover could very well occupy that niche, and they could apply some competitive pressure, especially if they seek to grow quickly to make this deal look more attractive over time.
All right, so I'm going to go back to kind of the bigger, broader picture, because I do feel like, Matt, that we've talked a lot about energy deals, I feel like, in the last 12 months or so. There just seems to be a lot of movement. To me, it's kind of an upbeat sign that companies feel confident enough to move ahead on some of these deals. Specifically, how are you looking at it? And specifically in the financial space, is there anybody, after guys reporting out this story, that you think, okay, they're thinking, all right, we need to do something, Matt?
I think that bank deals are hard to get across the finish line, and this was one of the most obvious things that could happen. That said, if you look at like just regional banking, if you go under, Citigroup down to like Regions Financial, there's like 10, 15 banks, and they're all ripe for consolidation. Fifth Third, Huntington Bank shares, Regions itself, KeyCorp. I can just keep going on and on. And they're actually really quite small in comparison to JP Morgan Chase and Bank of America. There is a lot of room for consolidation there, and I can guarantee you they're all sitting and watching this to see if it kind of goes through. But then there's also some other stuff we have to work through, like markdowns on loans, whether they can get there.
I do think about, Ben, and come back in here, do consumers win at all in all of this? Is bigger better ultimately for them, whether it's the regional bank consolidation or a deal like this? Or we don't know, time will tell.
Time will tell, but I think ultimately more competition is better for the consumers. It usually is. The Discover brand is really friendly to sort of middle market, kind of lower FICO, middle income consumers. So if Capital One really is devoted to keeping the brand alive, as they've said, then I think that they will strive to be a cost competitive network, which ultimately could sort of reduce costs overall for consumers. But again, they're so small relative to Visa and MasterCard that we're talking a decades-long process to sort of make any kind of big difference.
Okay, based on your reporting, Matt, does the deal happen? Do you think it happens?
Me? Yeah, I think it's probably going to happen.
Ben, you think it's going to happen based on your analysis at Bloomberg Intelligence?
Oh, well, I'll have to withhold final judgment to my colleague Jennery, who covers M&A for us. But I think it's politically driven right now, and I think the fundamentals of the deal are very good, and it doesn't appear to be anti-competitive to me.
And Ben, I mean, nobody comes in here and does an alternative offer, right?
I don't think so. And this is me just talking, this is speculation. I mean, the only other obvious one would be maybe PNC.
Okay.
Just they have the heft and maybe the ambition to do it. I don't know if they would be interested. That's the only one that really kind of jumps out at me. But I don't think it's happening. I think this is locked up.
All right, good stuff. Hey guys, thank you so much. So appreciate both of your perspectives. Matt Monks, deals editor at Bloomberg News here in studio. Ben Elliott, consumer finance analyst at our Bloomberg Intelligence team out there in our Washington, D.C. bureau.
Hey, let's stay in Washington, D.C. now for a check on the latest world and national news with Nancy Lyons in our D.C. newsroom. Hey, Nance.
Thanks, Tim. The World Health Organization says it has completed a second evacuation mission from Gaza's Nasser hospital, transferring a total of 32 critical patients, including children, from the site amid renewed fighting. The Nasser hospital in Khan Yunis is Gaza's second largest, and it stopped working last week after a week-long siege followed by a raid. WHO spokesman Tarek Jazarovic.
The reaction of Nasser complex is a massive blow to Gaza's health system. Facilities in the south are already operating well beyond maximum capacity, and the capacity of those 6 health facilities in south are only 450 beds, and the needs are much bigger.
Jasarovic says they're continuing to evacuate the remaining patients. Today at the UN, the U.S. vetoed a resolution calling for a ceasefire in Gaza, saying it would interfere with negotiations to free the remaining hostages. Former South Carolina Governor Nikki Haley says she plans to stay in the presidential race.
I refuse to quit. South Carolina will vote on Saturday, but on Sunday, I'll still be running for president. I'm not going anywhere.
During her speech today at Clemson University, Haley said she intends to compete until at least Super Tuesday, which is March 5th. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We've got the Dow, the S&P, NASDAQ 100 index, Russell 2000, all declining, with the S&P now lower by 36, drop there of 0.7%. Dow Industrials down 80, a decline of 0.2%. The NASDAQ Composite Index down 198 right now, a drop of 1.2%. The Russell 2000 lower by 1.6%. 10-year yield 4.26%, with a 2-year that's yielding 4.59%. Gold is up 0.5%. Spot gold now at $2,026 the ounce, and West Texas Intermediate crude oil is down 1.3%, 78.18 per barrel of WTI. Big tech dragging the stock market away from its record as Wall Street awaits NVIDIA's earnings tomorrow. NVIDIA shares today, they are down now by 4.9%. As we've been reporting, Capital One Financial has agreed to buy Discover Financial Services in a $35 billion all-stock deal to create the largest American credit card company by loan volume. Capital One Financial, ticker COF, up 0.1%. Discover Financial up by 12.7%. Again, recapping, stocks are lower. S&P down 34, a drop there of just about 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So we have talked about what may be the biggest brand shift in a company very well known in the weight loss industry, known to its many users for years, Tim, for its point counting program.
We're talking about none other than WW International. And you're asking yourself, okay, what is WW International? It's
Come
the
on,
company
you know.
formerly known as Weight Watchers. It's a huge brand shift. It's now embracing a new class of weight loss drugs, so moving away from the point counting and moving more toward delivering these new medicines, Ozempic, Wegovy, and others in a big way. Recently, Carol, it meant enlisting social media influencers to help out. Needless to say, sometimes this stuff doesn't always go as planned.
So true. Well, with the inside story on what is one of the most read stories on the Bloomberg today, Bloomberg News health reporter Madison Muller joining us here in studio. So another great story, another great insight into this world that has been disrupted by this new class of weight loss drugs. Take us into what you call in your story the GLP-1 hype house. Did they actually call it the GLP-1 hype house, or what?
They called it the GLP-1 house.
Okay.
So similar. And it was kind of a hype house. I mean, they had these massive replicas of injector pens and a blue carpet and, aprons that said it's giving protein and, different photo booths and things like that. So
Did you go?
I did not go.
But you saw pictures.
But
you
LA.
saw
Pictures, videos. It was all over social media, which was sort of the point, and it sort of brought you into what was happening there. But in the sort of days that have followed since, we originally reached out for this story, a lot of the videos are no longer online.
So talk to us a little bit about how it didn't go as planned, because that's a big part of this. That is the story here.
Yeah, so Weight Watchers has obviously been undergoing this huge brand shift, going from dieting and sort of pushing lifestyle changes to embracing these GLP-1 medications. And as part of that, they bought this telehealth platform, Sequence, last year. And until now, we didn't really know how they were going to integrate that with their brand. And then in December and January, they started launching this, officially rebranding it as Weight Watchers Clinic and launching a GLP-1 program, which is sort of supposed to be a support system like the typical Weight Watchers community for people on these drugs. And like Weight Watchers has done with, time and time again, sort of relying on social media influencers or forward-facing personalities like Oprah, people that have a big following to sort of promote its brand. And so they reached out to a lot of influencers, creators on social media who do talk about their Ozempic and Wegovy use to see if they would partner with the company to, support the brand, make videos about them on social media. And a lot of these influencers were like, one, it seemed disingenuous the way that they reached out about this. And two, we actually have a lot of bad experiences from diet culture and from the way that, bodies were talked about, dieting was talked about for so long that we wouldn't want to partner with a brand like Weight Watchers.
Yeah, it's interesting, right? Kind of the kickback. Having said that, there were some that did sign on and were all in.
Yeah, there were about a dozen that went to this hype house and posted videos from it and, have continued working with the brand. And it definitely looked fun.
I have to say what's interesting, and having covered this company for a fair amount of time with its predecessor, and when it shifted to being much more of kind of a wellness lifestyle brand, like it's not just you're losing weight, but you're also thinking about, I think, meditation, like other things, like completely holistic in terms of wellness. It's really kind of turned its back on that.
Yeah, I mean, yeah, that is the thing, and it's interesting because they were sort of trying to do that, I guess, in combination with promoting these medicines and prescribing these medicines. And the patients that I spoke to and the influencers that I spoke to were like, we don't really need this community or this points counting system because we're already getting that from our doctors or our community on social media. And so the things that, Weight Watchers was sort of trying to bring its brand and the things that it's done well and done for so many years into this next generation, but all of these patients are like, well, we don't really need them anymore.
Okay, speaking of the next generation, a big part of the story too is influencer culture and sort of what goes along with that. And it's, I think for a lot of companies, especially established companies that are trying to rebrand, this is something that they are trying to embrace because marketers find it effective, but at the same time, you don't have control over your message the same way you do when you have a quote unquote traditional campaign. Take us through this contract, because I was really surprised to see that for only $750, it required the person who was posting this to actually follow all these rules.
Yeah. I mean, the contract was also a problem. That the patients, the influencers that I talked to, they were like, the non-compete clause of this contract was extremely intense. I mean, they wouldn't let us work with any other weight loss brands, which I guess makes sense, but couldn't go on, weight loss shows like The Biggest Loser, couldn't even talk about other like types of diets like Whole30 or Paleo on their social media channels. They were like, it was just extremely restrictive. And, for someone that's trying to make a living off of social media and brand partnerships and different deals, like it's just not something that's super sustainable, especially when they're offering just $750 for a couple posts.
What does WW say? And I also bring in, they've got a CEO who's definitely savvy when it comes to the social media world and kind of social media
TikTok.
Communities, right? A lot of following. So I'm curious what the response has been.
So they would not comment for this story, but social media is clearly a big part of their strategy, and they have said that in the past, that they're going to continue to use social media. Their CEO is on social media, like you guys said. The chief medical officer has a podcast and, a ton of Instagram followers, and their dietitians are all on social media as well. It's like, it's very interesting for executives to be this forward-facing on social media. You don't really see that with the pharma companies.
No, that's so true.
Okay, Madison, I got to ask you, when you see an ad on traditional TV or hear one on the radio for a pharmaceutical company, there's a lot of fine print. They talk about the potential side effects. They talk about things that could go wrong. If you're an influencer just posting about using a product, it doesn't have that same regulatory oversight, does it?
Right. So this is a major gray area and something that is still sort of to be determined how it's even going to be regulated, because telehealth companies don't have to follow the same strict rules that pharma companies do when they're marketing a product. Obviously, pharma companies have to comply with FDA laws, and they have to, they can't overstate the benefits of a drug. They have to say the side effects. Telehealth companies don't really have to do that. And on social media, especially, that's a total gray. I mean, it's hard to regulate as is. And when you're working with patient influencers who are just sharing their own experience, it's even more difficult. And so this is sort of something that's spiraled out of control. And I was talking to a couple of experts about this last week, which we didn't really even get into this in this story, but there is sort of more of a push in Washington right now to regulate how telehealth companies specifically market pharmaceutical products on social media, which is so niche, but it's become such a big problem,
right?
That these telehealth companies can go and have a hype house where they have giant injector pens, and that's something you would never see a pharmaceutical company do. They just would not be allowed to get away with that. So it's really interesting, and the majority of the ads that we're seeing on social media or even in the subway, they're from telehealth companies. They're not from the drug makers themselves.
It's mind-blowing. But it also, you do wonder, and I know we're running out of time, but just what it means for WW moving forward, because this is a big part of their strategy.
Totally.
So if there's kind of blowback, pushback, this is important.
GLP-1 hype house. You ever think you'd say that?
No.
Okay, neither did I.
Madison, thank you so much. Madison Muller, health reporter at Bloomberg News. Hey, coming up next, we're going to talk a little bit more about Ozempic and all these drugs, what it means for food makers who will have to, yes, get healthier. That's next.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Sources tell Bloomberg the Federal Trade Commission and a group of states are poised to sue as soon as next week to block the tie-up between supermarket giants Kroger and Albertsons. The suit is expected before February 28th, when an agreement not to close the deal between the companies and the FTC expires. Right now, we got Kroger shares advancing by 1.3%. Albertsons up now by 0.3%. Wall Street is eagerly awaiting NVIDIA's earnings tomorrow for confirmation that the stock can meet sky-high expectations set by the boom in artificial intelligence. Today, NVIDIA ahead of earnings is lower by just about 4.6%. Earnings news, Walmart topped estimates in the fourth quarter. Separately, Walmart said it has agreed to buy smart TV maker Vizio Holding Corp for about $2.3 billion. This deal would accelerate the retailer's advertising business called Walmart Connect and help Walmart and its advertisers engage more with customers. Walmart shares up by 3.7%. Home Depot reported a fifth consecutive decline in revenue on weak demand, underscoring a drop in demand for home improvement thanks to higher interest rates and a slowdown in construction. Comparable sales fell 3.5% in the fiscal fourth quarter. Walmart shares again up by 3.7%. Macy's says it has received 9 nominations nominations to its board from Ark House Management. That is the activist investor leading an effort to acquire the department store company. Macy's said it would consider the directors, but noted it had previously rejected a $5.8 billion offer from Ark House and Brigade Capital Management. Macy's shares down now by 1%. Those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. Carol and I here in New York City. Let's get to Washington, D.C. now for a check of the latest world and national news. For that, we go to Nancy Lyons in the D.C. newsroom. Hey, Nance.
Hey, Tim. President Biden says he does plan on taking additional steps to sanction Russia for the death of opposition leader Alexei Navalny.
I told you we'd be announcing sanctions on Russia. We'll have a major package announced on Friday.
Issuing the sanctions Friday coincides with the 2-year anniversary of Russia's invasion of Ukraine. Biden has already said he holds Russian President Vladimir Putin responsible for Navalny's death. Elon Musk's X platform says it mistakenly suspended the account of Alexei Navalny's widow, Yulia. The account briefly went offline after Yulia Navalny posted this video.
Мы знаем, из-за чего конкретно Путин убил Алексея 3
She's promising to take over her husband's role as opposition leader. X says the account was mistakenly flagged for violating its rules, and as soon as it learned of the error, the account was restored. People close to the matter say the U.S. has told allies Russia could deploy a nuclear weapon or a mock warhead into space as early as this year. A nuclear warhead in orbit would violate the 1967 Outer Space Treaty. Today, Vladimir Putin denied the U.S. allegations. Republican presidential candidate Nikki Haley says she has no intention of quitting the race before Super Tuesday, regardless of the outcome of Saturday's primary in South Carolina, the state where she was once governor. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Carol and Tim.
All right, Nance, thank you so much. Nancy Lyons in D.C. All right, now to our one more thing this hour. So we were just talking with Madison Muller about WW and certainly their new strategy and their embracing, if you will, of the new weight loss or new class of weight loss drugs, Ozempic, Wegovy, all that good stuff. Well, our Bloomberg's M Live team did a survey. They do one every week, and they asked specifically about the impact these drugs are going to have maybe on companies and maybe how you're thinking about investing.
Yeah, we've seen, the reason we're talking about this is because over the last few months, you've seen a lot of reports from companies like snack foods makers, even airlines, Carol, who, a few months ago, the question was being asked by analysts, well, if people are going to be weighing less, to what extent are you going to use less fuel, and how is that going to affect your bottom line?
Yeah, or maybe seats, right, in terms of, I don't know, just lots of thinking about stuff. So here's what the survey found. Companies selling unhealthy foods need to tweak their business models to counter the growing popularity of weight loss drugs or risk alienating investors. This is according to the latest Bloomberg Markets Live Pulse survey.
Yeah, nearly 3 out of 4 respondents said companies making or marketing sugary, fatty, or ultra-processed foods should revise their game plans, either by shrinking portions, adjusting recipes, or offloading assets altogether. Just over a quarter of the 303 respondents think big food can wait out the emerging threat from appetite-suppressing drugs like Zepbound, Ozempic, and Wegovy.
Yeah, I think it's just interesting about, the respondents saying that they're thinking differently about where they're investing, right? We've talked about this with ESG for years, right? But specifically, if you think that these drugs will have a really significant impact on consumers, citizens, and then ultimately businesses who have to adapt, you've got a lot of people, right? 3 out of 4 respondents making different changes in terms of their asset allocation.
I also think it doesn't have to do with the drugs specifically and just the conversation that's happening around the drugs and the way that affects the choices that people make at the grocery store.
Right.
And just the fact that people are talking about this stuff to a different extent than they were a few years ago should make these companies think differently about, okay, what are we making and how are we marketing it?
We talk about disruption. There's still a lot to be known longer term, but nonetheless, it's definitely on our radar. All right, everybody, if you're watching on TV, coming up next is the close. For those of us, we're going to get into Bloomberg's annual rankings of the best paid hedge fund founders and Blink CEO Brendan Jones stopping by to talk about EVs. That's next on Business Week.
one too. So can I count that as a vacation?
It's cold outside.
Here.
It's gray.
You
I
were
need
away.
green. I
Okay.
need 60 degrees.
What
Come
happened
on,
to
Mother Nature.
that Florida remote that we were going to do?
What's up with that groundhog?
Yeah, I don't know. It's not going well.
All right, everybody. The markets, though, the equity markets, we're coming off our lows when it comes to the equity trade. We're going to get into what's going on in just a moment.
Hey, that's Carol Masser. I'm Tim Stenevec. Also, over the next 2 hours, the well-known investor that might be called the highest achiever in Bloomberg's annual rankings of the best-paid hedge fund founders. We've got that in the entire list. I'm going to give you a little hint. He likes to tweet.
He likes to tweet.
Yeah, how does that sound?
Well, a bunch of gold stars for him in this ranking. Amid the new slower EV adoption narrative, we're going to check in on the impact of Blink Charging. It's the company making chargers for a who's who list of companies. Blink CEO Brendan Jones, he's going to be stopping by and talking to Tim and me.
And we're staying on the real estate beat. That's sort of a theme of our program this year, Carol. We're going to catch up this afternoon with the head of global listed real assets at Morgan Stanley Investment Management. Talk to her about REITs and what else she thinks is interesting out there. I'll give you a little hint too there. Senior housing.
Senior housing.
Yeah.
We're all getting older. And then on that, kind of a related thing, 401k plans. Everybody, planning for their retirement, those who can. Why 401k plans might be gone within a decade. This is an opinion piece. Yeah, this caught our attention this morning.
Hey, what's going on in the trading day, Carol? You mentioned that we're off our session lows, but let's get over to Charlie Pellet for an update. Hey, Charlie.
Hi, thank you very much. And here's what's going on. Stocks are lower across the board with the S&P right now down 29 points, a decline of just about 0.6%. We have got the Dow Industrials down 33, lower by 0.1%. NASDAQ, though, the underperformer by far, down now by 1.1%. But we are off session lows as we move into the final hour of trading. 10-year, 4.27% with a 2-year right now, 4.60%. Fed minutes tomorrow. So what about the rate environment? Priya Misra is portfolio manager at JP Morgan Investment Management.
We started this year with the market pricing in the end point of cuts. So I actually look at the total amount of cuts. Whenever they start, I think it's somewhat irrelevant unless you're trading Fed fund futures. Right. It really matters in terms of total amount. We're now pricing in 375 in terms of that Fed funds rate at the end of all the cuts. The Fed thinks 2.5 is neutral. I think I might be more in the 3% camp. We're pricing in 375.
And you can hear more of that conversation on the Brief podcast. You can download it wherever you get your podcasts. Again, 10-year right now at 4.27%. Spot gold up 0.4%, 2,024 the ounce, while West Texas Intermediate crude is down 1.3%, 78.18 for a barrel of WTI. The activist investment firm Ancora Holdings is calling for a new management and an overhaul of the board at Norfolk Southern, the railroad that is still reeling from a costly derailment last year in Ohio. Shares of Norfolk Southern are trading at a 52-week high today. They're up by 1%. CSX up now by 0.2%, while Union Pacific is up by 0.1%. Recapping stocks lower. S&P down 31, drop there of 0.6%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Well, big tech names in focus today as they drag down the overall trade ahead of an important earnings from another big tech name. We're talking about the AI darling NVIDIA, which reports tomorrow and which is under a lot of pressure in today's session.
So with more on the trade and the trends in U.S. financial markets today, back with us is Bloomberg News markets reporter Abigail Doolittle. She's here in our Bloomberg Interactive Brokers studio. So if I pull up the S&P 500, Abigail, at the bottom of the pack are the big tech names. Why are we seeing such a sell-off today when it comes to companies like Tesla, companies like NVIDIA, off of their lows? But the chip makers, let's start with them.
I think it really is being driven by NVIDIA. I mean, this is a stock that over the last year, even with today's decline, is up more than 230%. Valuation not off of the charts, but, it's pretty high when you have a stock gaining that much. I think that the biggest thing that folks are a little bit nervous about is if I pull up on the Bloomberg terminal, the FA function to take a look at the growth, on a year-over-year basis, folks are looking for 407% adjusted earnings growth on the full year basis. On a quarterly basis, I'm just diving in a little bit more. So this is really pretty stunning. So we're looking for 614% growth on a year-over-year basis for earnings. This after earnings grew in the October quarter by nearly 1,100%. The quarter before that, 740%.
So it's not so crazy to expect it.
It's not so crazy to expect it, but at some time I would say it's going to stop. And so if all of a sudden the music stops tomorrow, I think that's actually really what it is. Having seen like a lot of companies trade, there's a fear that you want to have your seat before the music stops. So I think some investors taking the seat today, they'll take it tomorrow. If the music stops, then they'll have their seat. If it doesn't, they'll be right back off to the races. But just a little bit of protection.
How much impact? I'm looking, NVIDIA is about 4% of the S&P. It's about 5% of the NASDAQ 100. It's about almost 10% of the SOX. So when you think about what the results might ultimately be and what the impact could be on the overall trade.
Well, if it's to the downside, if there's a downside bomb, it will be not as much from the actual weighting standpoint, but from the sentiment standpoint. I think that folks will be thinking, well, the AI party, it's either paused, stopped, or there's some kind of little blip, but it will definitely cause a reaction. If it's to the upside, it will be the same. I mean, if you recall back in May when they put up that ridiculous guide, their revenue guide, I think, was 50% better than was expected to be. I've never seen that before for a big company. The stock had its best day ever. I think it was up by 25% in that one day, and it just gave a lift. That could happen again if they put out some sort of a blowout quarter. The fact that the stock is trading weak into it isn't a great sign, because it should suggest, like last week we were talking about technicals, it suggests that some of the early smart investors, some of the people who have information, they're lightening up a little bit right now. They're not buying into the quarter. And in fact, over the last 2 days, today and, it's been down 3 days in a row now. So over the last 3 days, it has shed about 7 to 8% or so. So that's telling you that some people think that it could be a little bit wobbly, that it might not be the perfection that a 230% one-year rally demands.
I always ask you, on heavy volume, or what kind of volume behind these trades? Like,
let me take a look at the volume.
I'm curious if like investors are kind of running.
Yeah, if it's with force or not with force. Pulling up the chart right now. It's kind of just in line. It is actually a little bit heavier. If you take a look at the 10-day moving average, I think it's the 10-day average, 15-day average, that's starting to trend up a little bit. So the selling we're seeing. The other thing that's happening right now from just a pure technical standpoint, and this tells you, I would say that this is even a stronger indication than the volume, is today's low is lower than the low from about a week before. So these sellers, they have conviction. They're a little bit nervous.
Okay, the SOX is down 1.7%. So we are seeing chip makers under pressure. What else needs to be on our radar when we're talking about companies outside of semis, companies outside of NVIDIA right now?
Well, I have to bring it right back to what you brought it back to last week, which is Apple, because we do have Apple down, and Apple is solidly below its 200-day moving average. That's a very fancy way of saying that the longer-term buyers and sellers, neither really knows, but the fact that it's below it tells you that the buyers have less confidence than the sellers. They're looking for more information one way or the other. A negative NVIDIA report shouldn't have an actual effect on Apple in terms of fundamentals, but that sentiment, it could be a problem for all big tech. So that's something else that I've been watching. From a non-stock standpoint, I'm watching yields, because it's interesting. Today's a risk-off day. We have bonds rallying, and it's very interesting only from the standpoint that there are some, as we were talking about last week, Lawrence Summers talking about the idea that the next move could be a hike as opposed to a cut.
We talked about it at the top of our broadcast.
Yeah, so that the fact that we have yields in, even as that's the narrative, a possible narrative, tells you that the bid for bonds has much more to do with safety as opposed to the Fed. You take a look at oil being down. Today is a little bit of a risk-off flavor. The VIX is higher. The VIX has a 15 handle, although like historically that's not anything.
Do you care when we look at the S&P 500, and I just look at the DES page on the Bloomberg, and it just shows, almost an even split in terms of names to the upside, names to the downside, a little bit more of a negative tone to the downside. Does that matter to you? Does it? Because sometimes I look at the major, averages and what they're doing, I'm like, oh wait, but there's still half of the names, or almost half the names in the S&P are gaining ground.
So one way to answer that would be if you were to do that on the SPW, the equal weight, then it would make a difference, because say 95% of the members were down, the index would be down. Because the S&P 500 is weighted, it is important because it tells you that from a broader breadth standpoint.
And SPW is almost an even split today.
And the interesting thing is, so this is the difference. It creates basically a 0.4% difference in terms of the stocks that are higher and lower, just having to do with that weighting factor. So I guess I guess we can learn from this that there's a 0.4% difference that goes toward the weighting. So the weighting, seeing that even split is helpful just to see that it's not an absolute I'm going to use some words that I prefer not to use just because they're pretty negative. But it's not there's not a ton of red on the screen. But because of the weighting, because some of them are NVIDIA, Amazon, Tesla, Microsoft, Apple, AMD, there's a little bit more of a decline with it.
All right, good stuff. It sounds like, we're kind of waiting for NVIDIA.
Well, that's what's that's what's interesting.
We're always waiting on something.
Yeah,
yes, always.
So down 0.5 percentage point on the S&P 500, but 235 stocks are higher, 265 stocks are lower.
That's
so,
why I'm like, I always wonder if that's a kind of a silly thing to be looking at. But
No, it's not.
I try to get
it's always helpful. And I mean, take a look at the stocks that are up: Walmart, Coca-Cola, Abbott, Berkshire. We even have Alphabet up in there. But there's some. So one thing you can say is that today the Magnificent Seven, not so magnificent, but the rest of the market, from a breadth standpoint, there's not as much of an influence. So that's why we're not seeing on an index level. But they're doing better.
Right. And
Walmart all-time high.
Exactly. And you continue to see names being impacted by kind of fundamental stories behind them, whether it's earnings or doing a deal or so on and so forth.
Yes.
Which I always think is interesting. Abigail, thank you as always. Of course, she's Bloomberg News Markets reporter Abigail Doolittle right here in our Bloomberg Interactive Broker Studio. This is Bloomberg.
Those are a couple of things that I think it's fair to say. Just type in, by the way, Rich Go on the Bloomberg terminal, and that's how you get to the Bloomberg Billionaires Index. One list that taps into both is Bloomberg's annual list of the best paid hedge fund founders. For more on what is the most read story on the Bloomberg today and who took top honors, we welcome Bloomberg News hedge fund reporter Hema Parmar. She's here in our Bloomberg Interactive Broker studio with more on her story that she wrote along with Bloomberg's Tom Maloney. Hema joins us now in our studio. Hema, good to have you with us this afternoon. Do I do a drum roll, Carol? Is it the type of list that we do a drum roll for?
I don't know. Ask Hema. She's the expert.
I mean, this is a thing.
I'll take a drum roll.
Okay, yeah, we can do the drum roll. Okay, I'm doing the drum roll now. At the top of the list, a man who likes to tweet and a man who didn't do much with his fund last year.
Yes, so really interesting. We're talking about Bill Ackman, of course. He has been all over Twitter recently, and he is number 7 on our list, which is the highest he's been since we've done this ranking. And what's interesting is he took home $600 million after basically just sort of adjusting his portfolio of 10 stocks kind of on the margins. He brought down one position a fair bit, but in general, it's a highly concentrated book, and it's worked out well. The fund was up almost 27%.
Not too bad.
But they didn't do a whole lot to it recently. A chunk of his gains did come from the fact that it's a publicly traded Pershing Square holdings, and so that helped him a great deal too. A good third of his money came from there.
Yeah, it's interesting when I was looking over this list. Take a step back for us. How do you put this together? Because your methodology in this story, there's a nice, a big, long explainer.
Yes.
There's got to be a lot of stuff you have to go through to figure this out.
Yes, so Tom Maloney is my colleague on the story. He is the wizard behind doing all the calculations. And so we do take our time to get all the right inputs, assess how the fund did, look at their public filings, assess who gets what stake of the fees and has ownership stake. So you can read the nice, very thorough methodology at the bottom of the story, but it does take a minute.
Well, and the reason I do ask is how much is performance, how much is fees ultimately, and how much these dudes make?
Yes,
And
so
they were all dudes, weren't they?
They were all
Was there-
dudes. Yeah, I don't think we've ever actually had a woman on this ranking before. Not yet.
That makes me sad, but go ahead.
Me too. So if you look at the story, we do show you, for example, Izzy Englander, he made $2.8 billion. We divided up as to how much he made on his gains in the personal investment in the fund.
Yeah.
And then how much comes from the share of performance fees. You'll see, across the board, most of the money is coming from the fund's performance. But, I mean, it's not unsubstantial. Izzy took nearly $1 billion just from fees alone. Ken Griffin, $1.1 billion from fees alone. So it's hefty still.
What's the fee breakdown traditionally versus what it is right now? I mean, 2 and 20 is what you hear about with hedge funds, but it's a little more complicated than that.
So it depends on the fund. If it's a big name fund that everybody wants to get into that has strong performance, that you can charge 2 and 20 or sometimes 2 and 30, or Element charged as much as 40% performance fee. They bumped that up. So then you can. Smaller, emerging, newer funds typically bring that way down. The multi-manager funds, so like a Millennium or Citadel, they have a pass-through, so they pass on a lot of the costs, like compensation, leases, a whole bunch of stuff to the clients. So they pay for that.
So is the management fee included in performance fee?
The management fee and the performance fee, you mean for multi-strat specifically?
Well, no, just for when we look at the top 15 earners.
Top 15.
Yeah.
So we, in our methodology, we assume that the management fees go towards managing the company. So we do not factor that in. The performance fees are what we look at because these firms do charge a management fee to help keep the lights on. So it's the billionaire
Keep the lights on and the jet's fueled.
There you go.
Yeah.
You know what's wild is that when I look at Bill Ackman and Pershing Square's equity bets, I guess for sometimes I always think, it's all these sophisticated investment strategies. A lot of times it's just plain old stocks.
It's Chipotle, Alphabet, Hilton. Yeah,
it's
names we know.
Right,
Yeah.
it's kind of fascinating. Ones that have been on a run. Having said that, I am curious. Some of these names, obviously Bill Ackman we know because he is pretty out there when it comes to social media, and we often have stories.
Yes.
Somebody like TCI Fund Management's Chris Hohn.
Chris Hohn, yes.
So tell us about him, because it's not a name we talk about regularly, but he earned a lot on just 10 U.S. stock names.
So 10 U.S. stock names. He may have a few others that are international that we don't see in their 13F filings. But regardless, he runs a very concentrated long bias portfolio, so mostly longs versus shorts. He did very well. He's been on our list almost consistently, I think every year, if not almost every year.
Right.
He made nearly $1 billion last year. His fund was up 33%. Basically
Nice.
the best performer of the group, on very concentrated bets. They're sizable. And most of his money, 700 of his 900, came from the gains on that fund alone. So,
wow.
Yes.
Do you want to be in a position as a manager to have, I guess from a client's perspective, somebody like David Tepper, whose $2.3 billion payday last year
Yes.
came almost 100% from personal investment versus fund performance.
Yes.
Who do you want to be? What does the mix? What's the mix you want?
That's a very good question. For Tepper, I would say because he's returned a lot of outside capital, he still manages some, but it's smaller than he used to, so he's getting fewer fees just from that alone, and he doesn't charge himself fees. So I think it depends. I mean, people talk about the multi-strategy model a lot. The clients complain about it a lot because they pay for so much and it's so expensive. But then you have a year, like a couple years ago, and Citadel was up 30% net of fees. But this year, the reason they're under a bit more scrutiny right now is because they tend to be in leverage bets. They tend to, they have had mediocre performance last year. So it's been a little bit rougher recently.
How much does this list change from year to year in terms of the top 10 or 15?
So I would say you see a lot of the repeat names.
Yeah. Do they shift around
Ken
much?
you do see them shifting around. I think Ken's a little bit higher.
Ken Griffin?
Yes. Than he was before. Actually, no, correct that. Ken was number 1 last year. He made, I think, $3 or $4 billion.
Number 2 this year.
So number 2 this year. But you do see a lot of the same repeat people, but we have seen a number of names fall off the list. So after 2022, the Tiger Cubs struggled. We talked a lot about a lot of these funds going through a lot of pain. They have to make up those losses. And so the reason why you don't see Chase Coleman or someone on the list is because they're trying to get themselves out of that hole.
Well, as we said, the most read story on the Bloomberg today. Hema Parmar, hedge fund reporter at Bloomberg News. Be sure to check it out at Bloomberg.com. Joining us in studio. This is Bloomberg.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are trading lower. Red on the screen now. 38 minutes to go ahead of the closing bell. S&P right now down 30 at 49.75. We're off session lows, but still looking at a drop of 0.6% on the S&P 500 index. The Dow now lower by 55, decline there of 0.1%. Nasdaq down 167, drop there of 1.1%, while the Nasdaq 100 index down 0.9%. And the Russell 2000 index of small cap shares trading lower by 1.4%. 10-year 4.27% with a 2-year 4.60%. Spot gold up 0.3%, 2024 the ounce, while West Texas Intermediate crude is down 1.3%, 78.18 for a barrel of WTI. This morning we heard from two high-profile retailers, Walmart and Home Depot. So what can we learn about the health of the consumer? Joanne Feeney is a partner and portfolio manager at Advisors Capital Management.
Overall, we have more people employed than we've had ever. They're making good wages. Their real disposable personal income has been rising. So overall spending from the consumer remains quite strong.
And right now we've got shares of Home Depot after earnings up 0.5%. Walmart after earnings up by 3.7%. Wall Street, meanwhile, eagerly awaiting NVIDIA's earnings due out tomorrow for confirmation that the stock can meet sky-high expectations set by the boom in artificial intelligence. Ahead of its report, we've got NVIDIA down now by 4.7%. Recapping stocks lower, S&P down 31, decline right now of 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really appreciate it. Hey, check out the new Bloomberg Business app featuring Apple CarPlay and Android Auto. You can listen to Bloomberg Business Week and all of our Bloomberg radio programs at any time. All you got to do is download the Bloomberg Business app on your smartphone and connect your phone to your car. It's free in the Apple App Store or on Google Play.
All right, everybody, it is time for another edition of Bloomberg Plugged In. It's your weekly look at EVs, and this week we're focusing on a crucial component of EVs, the chargers, because after all, if you don't have any chargers, I mean, there are no EVs. It's basic.
We've got back with us Brendan Jones, President and CEO of Blink Charging. The company customers include Alphabet, Amazon, AutoNation, Ford, GM, and hotels and cities around the country. He's back with us from Washington, D.C. Blink Charging builds EV charging networks. Brendan, good to have you back with us. How are you?
It's great to be on again. We're doing great.
Good. Hey, I want to talk about the company in just a second, but just today we got the news that Ford is cutting the price of its Mustang Mach-E by as much as $8,100 after sales tumbled more than 50% in January. Ford also cutting production of the Mach-E and the F-150 Lightning plug-in pickup truck. It's been a theme of our broadcast this year, is just the rebalancing when it comes to supply and demand of EVs and what a difference just a couple of years has made. How do you see this space right now?
Well, despite of what we see as some cuts from certain OEMs, we're still seeing an overall increase in the market. The U.S. had 1.3 million EV sales last year. And if you're a single OEM and you had 1.3 million sales, that would be outstanding. And even Bloomberg yourselves, you still see an increase. In 2023, we're 14 million. You're projecting 16.7 million next year. So while it may slow down a bit, the industry is still moving forward and progressing. There's going to be some structural adjustment, but we're still seeing the OEMs have invested north of $700 billion in EV platforms. And those vehicles are still coming to market. Some are going to do better than others. Others need price adjustments. We still need the cost of the battery to come down a little bit to get parity with internal combustion engines. But all that is happening. So we remain optimistic, maybe a little slower. But when we think about the gap between EV sales on the vehicle side and the need for infrastructure, there's a lot of catch-up work to be done on the infrastructure. So we see nothing but increased orders and increased revenue for Blink.
Increased orders, increased revenue for you guys, but at a slower pace. Is that the kind of reset, to be fair, Brendan?
Yeah, it may be but we're going to be very cautionary on at a slight pace. We just announced a couple days ago that we're going to hit 140 million in revenue. That's an astronomically high number from where we were 3 years ago. When I joined the company to structurally adjust it, the previous year revenue was just $2 million. And now we're at $140 million. And I can't and I wouldn't predict that we're going to see that same growth factor because a lot has changed in the interim, but we still see growth. And when we give guidance out after March 15th for 2024, you'll see those in our numbers.
Yeah, and to be fair, that 2023 revenue that you said to surpass 140, the consensus on the street was 132.33 million. Your stock was up more than 30%, more than 32% to be fair, when you reported earnings and gave that outlook. That was back on February 14th. Happy Valentine's Day, everybody.
Hey, Brendan,
Thank you for that.
what is holding back customers in the U.S. from widespread adoption right now? Is it purely cost?
Cost is an element, but we see some lower price models coming in. Perception, we have to really improve the dialogue. I mean, the benefit of an EV is really that you can plug it in anywhere. But when you look at the share of voice when we talk about EV infrastructure, it's really a lot on public-based DC fast charging. When reality, according to all the data, 90 to 90+% of the charging is going to be on level 2 charging. That is either in the home or the workplace or the apartment building, the multifamily dwelling, the doctor's office, and it's much easier to install. But we have most of the public holding back, waiting for that visible sign to see a DC fast charger. But we got to break that myth. That's the old paradigm. The new paradigm is charge anywhere. And unfortunately, as Americans, we think we use our car more than we do, but the DOT has had consistent stats for the last 30 years. They sit 95% of the time. Charge them where they sit. It's more economical. It's less capital. It's easier to do, and we can put more ports out there.
Well, how likely is that broader pivot towards the slower level 2 charges, which is what you guys focus on? If plug-in hybrids gain share, I'm just curious how you see it, and the need for that fast chargers become less critical. So give us an idea if you see that broader pivot.
You still have that.
Yeah.
If you look at our portfolio today, I'll give you that as an example. And we have hybrids that are charging on our chargers every day. We will maintain that 90-10 split. 10% is going to be DC and 90% is going to be L2. Well, we think that's healthy. That's globally, right? Because we're not United States based. We're in Europe, we're in the United States, we're moving into Southeast Asia, we're in Greece already. We're globally. We're in 27 countries that we have today. So we have the benefit of seeing where the future utilization is going to be, especially in the European countries, that they've already structurally adjusted. And utilization on our chargers there is way up compared to the United States. And eventually, that's going to come to the United States. So hybrids that are coming out have now a dependency on just being electric. And that dependency on being electric is going to drive the need for charging.
When do we get to a point, though, where we see EVs are as easy to charge as an internal combustion engine vehicle?
Well, I think we're getting close now with the paradigm, and you're talking about in terms of speed when you're talking about public charging, right?
Speed would be great. I was just thinking of number of places you can fill up your tank versus number of places you can fill up your battery.
Right. So we're heading there, but again, remember, it's a different paradigm, and that's what we have to keep in mind. I worked for many DC fast charger companies in my past, but I did all my charging at home and at work because that's where the charger was, right?
Yeah.
So I was always full.
Was it a DC fast charger at work?
There was a DC fast charger at work, but I didn't need to hook up to it. It costs more money. It's more expensive to operate. I just plugged into the L2.
And just so we are clear to everybody out there, level 1 charging is 120 volts. Takes between 12 hours and a full day, so you can do that one at home. You could do level 2 at home as well, 3 to 8 hours. Level 3 is 480 volts, and that can charge something in 30 to 60 minutes.
Depending on the car and the architecture.
Okay.
And depending on the charger itself, because it might only be 100 kilowatt DC fast charge. It could be a 50 or a 30, right? So, and then the battery has to have a speed which it'll accept the charge. So, we look at a lot of the generalities to the high end and say that's where it's going to be, but really it's going to be somewhere in the middle.
Brendan, though, going back to we've talked a lot here at Bloomberg, our team, Keith Naughton and others, have really done some great reporting on the uptick in those hybrids rather than pure EVs, if you will. That pivot, if that continues, how do you assess or describe that impact on your business? Or how does it change the outlook?
We don't think it changed that greatly, but we really don't see that as a long-standing thing. I mean, and here's the reality. China is moving to pure EVs. Europe is moving to pure EVs. And a lot of the European manufacturers are pushing pure EV strategies in the U.S. While we might have some slowdown, the U.S. is heading in this direction. Hybrids already exist, so those power plants are no. But in the end, they're a horribly inefficient power plant because you're running two different systems in a car, and that is suboptimal by any engineering standards. So eventually, it's going to give way to pure electric vehicles.
Really quickly, 30 seconds, who are your biggest customers? Who's buying it most? Is it municipalities? Is it the automakers? Is it Amazon? Who is it? Real quickly.
It's a great question, and it's actually all of the above now. The biggest booming part of the space is fleet. Both municipal and commercial fleets are buying chargers night and day all over the place right now. But also, we're doing a strong book of business with healthcare. We do it with hospitality. We do it with long dwell times.
Yeah.
So it's pretty consistent in the shift. And we're seeing orders increase, not decrease.
Got it.
So we're pretty optimistic about it.
Always good to check in with you. Brendan Jones, President and Chief Executive Officer of Blink Charging, joining us from Washington, D.C.
Hey, let's stay in Washington, D.C. now for check the latest world and national news with Nancy Lyons. Hey there, Nance.
Hey, Tim. The Biden administration says it will be toughening sanctions against Russia following the death of opposition leader Alexei Navalny. The White House says it will be putting forward major sanctions on Friday. National Security Advisor Jake Sullivan says it will cover the Russia Defense Industrial Base. The U.S. has vetoed a UN Security Council resolution that called for an immediate ceasefire in Gaza. This comes as President Biden faces mounting pressure to dial back support for Israel. U.S. Ambassador to the UN, Linda Thomas-Greenfield, says the country could not support a resolution that would put sensitive hostage negotiations in jeopardy.
This hostage deal would bring an immediate and sustained period of calm to Gaza for at least 6 weeks. And from there, we could take the time to build a more enduring peace.
Thomas Greenfield also said allowing a humanitarian ceasefire like the one proposed would empower Hamas. The Supreme Court is steering clear of a fight over the admissions policy at an elite public high school in the Washington, D.C. area. Bloomberg's Nathan Hager reports.
The case involves admissions at Thomas Jefferson High School for Science and Technology in Northern Virginia. The local school board says the policy it adopted in 2020 was designed to draw more students from different economic backgrounds from across the county. Parents who challenged the policy say it was actually designed to cut the percentage of Asian American students. This decision is a blow to affirmative action opponents who had hoped to extend last year's Supreme Court decision barring racial preferences at colleges and universities. In Washington, I'm Nathan Hager, Bloomberg Radio.
Missouri prosecutors say 2 adults have been charged with murder in last week's shooting that killed 1 person and injured 22 others after the Kansas City Chiefs Super Bowl parade. The new charges come after 2 juveniles were charged last week. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks trading lower. 20 minutes to go ahead of the closing bell. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
And good afternoon, Charlie. Big tech companies are dragging stocks lower ahead of NVIDIA's earnings tomorrow. The Dow is down 125 points, S&P lower by 40, with the Nasdaq falling 200 points. The U.S. 10-year yield is at 4.27%, and small caps are down 10. 9 of the 11 main S&P sectors are trading lower, led by declines in technology and consumer discretionary, while consumer staples and utilities are the only groups in the green. Nasdaq biotechs fall 35 points, transports drop 1%, semis are down by 70 points, while the VIX is higher by 4%. Leaders in the Dow, Walmart, Intel, and Coke, while Caterpillar, IBM, and Disney are the worst performers. After earnings, Walmart rose to a record high after beating expectations and agreeing to buy TV maker Vizio, and Home Depot paired an initial drop to trade higher despite a fifth straight quarter of declining sales. In deal news, Senator Warren said Capital One's $35 billion takeover of Discover should be blocked. Capital One is up modestly, while Discover is having its best day since 2020. Wrapping things up, look for earnings from Caesars and Toll Brothers after the bell. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, well, thank you very much, Bailey. And to hear live breaking news over your Bloomberg, type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive? You know,
no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. Just got about 17 and a half minutes left
Is
in
that
today's session.
it?
What do you mean?
That's it.
I don't know.
Markets
It
are
felt
close.
like a long day today.
You know, it should be a quiet week because a lot of New York City schools are out.
Yeah,
So you have a lot of people on vacation.
true.
Yeah, we're seeing actually volume is kind of average over the last 5 days.
Sorry, average volume.
Yeah.
No one likes to be called average.
But I think, everybody's waiting for NVIDIA earnings.
I think so. After talking to Abigail Doolittle, I feel like we're banking on that for, not only the company, whether it lives up to these lofty expectations, although she said the valuation maybe is not so unreasonable at this point, but the sentiment, right? Because of the AI play.
300% last year.
Yeah.
Best performer in the S&P 500 last year. Still the best performer this year.
Unbelievable. All right, so let's see what Jimmy Lee has to say about all of this. It is our time for the drive to the close. Jimmy Lee, back with us, founder and CEO of the Wealth Consulting Group, joins us from Sea Island, Georgia. The Wealth Consulting Group, by the way, has about $5 billion in assets under management. Jimmy, hey, nice to have you back with us. How are you?
Great to see you. I'm doing great.
So are you waiting to see what NVIDIA has to say like the rest of us?
I am, just like the rest of the world, at least the people that care about investments. My best guess is that NVIDIA probably produces a pretty good report, but we'll see if they were able to keep up with demand. We know the demand's strong, but there's so much excitement and enthusiasm around AI. I think that's one of the reasons why we're seeing some selling going into tomorrow's report. That I think most analysts, or a lot of analysts, believe that it's priced to perfection, and regardless of what they say, there's going to be some profit taking.
So how are you looking at tomorrow's results as a bellwether for the wider market?
This year is starting off a little bit like last year in the sense that we've got still, again, a small group of companies sort of determining what the index returns are to a large degree, with a few notable, differences, right? It's not all the Magnificent Seven stocks that are performing well year to date, with a few of those not doing as well. And also, it's a little bit broader year to date. I think we've got some cyclical sectors like financials and industrials that are doing pretty well so far. So I think we're a little bit better than we were last year. And also, we've had some recent corporate layoff announcements, but still not as much as what we saw in Q1 of last year. And so I think companies are still being very careful about how they're managing their balance sheets and cash flow and wanting to prepare for a recession if we do get one, which again, I know we've talked a lot about this throughout last year and now my first chance this year. I really don't think we're going to get one this year. And just like we did last year, and I don't think we're going to get a market sell-off. I think we're going to have a pretty good year for stocks, but also bond investors, I think will have a good year this year.
And that is based on what do you think we're going to get from the Fed in terms of policy, rate cuts, or perhaps maybe even some more rate increases, which is kind of how we kicked off our broadcast almost 2 hours ago.
You know, Carol, I really don't think we're going to get any rate increases. And I do believe that the Fed is going to be a tailwind for risk assets such as stocks or equities and even real estate this year. So I think at the end of the day, when we look back at this year, I think you're going to see the Fed being a friend, not a foe. That being said, you know, this idea for higher for longer, at least in the short term, it looks like the Fed is not going to be reducing rates possibly as early as you know, June maybe is when that's going to happen. Maybe it comes in May, I don't know. What's happening right now is investors are rotating which sectors to put their money into based on when they think the Fed's going to announce their first rate cut. And so when interest rates start to go down and inflation data looks better, you get all the cyclical sectors doing better and then small cap companies doing better than large. On the other hand, when rates go up, you see the exact opposite. So I think a good way to play that right now is to be overweight some of the names or the sectors that are still doing well, and also will do well if we do get a rate cut, which I believe is tech. And on the other end, though, of that barbell, maybe have some of those other cyclical sectors, such as financials, industrials, and make sure that you've got enough exposure into, you know, not just mega caps, but mid caps, small caps, even though small caps are underperforming large caps again. And I also think that for the remainder of the year and possibly for an intermediate term trend, the dollar is going to be a little softer. So I think international equities should also be represented in a good diversified equity portfolio, and make sure you have enough of that.
Hey, Jimmy, you know, guilty as charged for logging into my Bloomberg terminal over the weekend, Carol, because we actually had some really good stories published, including this one about a $6 trillion wall of cash holding firm as the Fed delays cuts. And what it's all about is the $6 trillion of money market funds that are out there right now. Investors have added $128 billion to U.S. money market funds since the start of the year, Jimmy. Are those investors making a mistake being in money market funds right now?
I think they are. And as you know, I was calling that investment a sucker bet for people's long-term money last year. I still believe that to be the case. Our own CIO, Jim Warden, produced a chart for us using data from the ICI. And, you know, it showed from the lows of October 2022, there have been, I think there was a negative $214 billion of net outflows into equity mutual funds and ETFs. I think positive inflows of about $150 billion into bonds, bond funds and ETFs. And I think like $1.4 trillion into money market funds of the big cash pile of trillions. So this does not look like a market that is a bubble that investors have been chasing. It looks like the biggest bull market that investors have missed.
What if, though, the lagging effect of all of this aggressive monetary policy, the Fed, you know, aggressively raising rates in a short period of time, what if we haven't yet felt it all? Is that possible at all in your view?
It sure is possible. I was looking at a report from Mark Zaney this morning, though, that showed the stabilization of, you know, the lowest or the most, you know, potential weak part of the consumer and delinquency rates on autos and credit cards kind of stabilizing. So I think that hopefully that's good news, is that it is stabilizing and not going higher. And I do believe, though, that the Fed does need to lower rates sooner than later, so that we do hold off and with this resilient consumer avoid a recession. But I do believe we could fall into recession if the Fed is you know, high for too long. And so I don't think that's what they're going to do. Yeah. The stubborn inflation data, when it's not good, a lot of it's due to housing data. And as you know, I've been saying that's you know, looking at it with the rearview mirror. So
Okay.
hopefully that looks better too.
Yeah, we'll get another read on housing when Toll Brothers reports after the close today. Hey, Jimmy Lee, thank you. Founder, CEO of the Wealth Consulting Group, joining us from Georgia. Just about 10 minutes away from the close. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Sources tell Bloomberg Federal Trade Commission and a group of states are poised to sue as soon as next week to block the tie-up between supermarket giants Kroger and Albertsons. This suit is expected before February 28th, when an agreement not to close the deal between the companies and the FTC expires. Kroger shares, they're up right now by 0.8%. Albertsons shares, they're trading lower, down now by 1.3%. ExxonMobil has pledged not to curtail exploration or production plans in Guyana as Venezuelan President Nicolas Maduro continues to ramp up his territorial claims in the region. Upstream President Liam Mallon spoke this morning with Bloomberg Surveillance, and he discussed the oil giant's commitment and expansion in Guyana.
This is a country that is blessed with fantastic rocks, the rocks that produce the oil. You know, a great partnership, great supportive government policies. We're doing it with lower emissions. We're spreading the benefits across the country. It is the kind of success, the kind of opportunity that comes along pretty rarely in a lifetime.
The Texas oil giant now produces about 645,000 barrels a day from Guyanese waters, and that is up from nothing 5 years ago. He was interviewed this morning at the Guyana Energy Conference. You can hear more of the conversation on the Surveillance podcast. ExxonMobil shares, they're down now by 1%. Apple's Chief Operating Officer Jeff Williams is on a rare visit to Taiwan to celebrate the 50th anniversary of Foxconn. That is the company that helped build the iPhone empire by assembling those devices to exacting standards in factories across China. Apple shares down 0.6%. Those are our top company stories, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, we've got just about 4.5 minutes left in today's trading session. Charlie, of course, breaking down the numbers. We're going to head over to our TV colleagues in just a moment. We're going to talk about the close here. Having said that, this just like gets what do they say? Gets under my skin.
Yeah, it's
makes me crazy.
Okay, I got a lot of thoughts here, and I don't think I can get them all in 2 minutes. Okay. But Mary Schlangenstein's got a story about American Airlines raising the cost to check bags. This, just as an annual report, shows the amount airlines collected from such fees last year.
Remember you were talking about drum rolls?
Grew to an estimated $33.3 billion.
That's American.
Okay,
oh,
that's
airlines.
all. That's all airlines.
All of them.
Yeah. So how much is it going to cost you? Well, it's going to cost you $35 for the first checked bag if paid online for American, up from $30 for domestic flights. The first checked bag will cost $40 if paid at the airport, also an increase from $30. The second bag will be $45. That's crazy.
And Scott Chandler, American Senior VP for Revenue Management and Loyalty, says we haven't adjusted domestic bag fees since 2018. We're just trying to match inflationary costs linked to delivering bags.
You know what they should charge for?
Yeah, what?
They should charge for carry-ons and make check bags free. I'm serious.
Because
hear me out.
No.
This is not a bad idea.
Amen.
Okay.
Amen, brother.
Charge for carry-ons.
Yes.
Because then it will limit the amount of stuff that people bring on planes. It'll make it easier to get on the plane and off the plane. People won't be fighting for overhead storage space.
Correct.
And it'll just make things so much easier going through security and being at the airport.
Planes lighter? Well,
you know
no,
what? If I ran on this, if Trump or Biden ran on this,
yes,
they'd be a shoo-in. That's all you need.
It's not the economy, stupid. It's the baggage fees.
It's the baggage fees. All right, but okay, I'll let you talk in a second, Carol.
No, keep going.
Okay, because this is I'm on like a soapbox here. One way you can get around this, of course, is with credit cards, airline status, but also if you check a car seat, you can check a car seat for free.
What?
Yeah. Thank God you can.
I mean, I love all of you who have babies, and I've done this before, but are you kidding me?
You know what? Throw as much as you can in that car seat bag.
So I'm just going to start bringing a car seat bag.
Throwing it out there. Throw some diapers in there.
The kid is somewhere. The hubby's coming, but
you
this
might
is
have
the
to
car
have a kid
seat.
with you. I don't know.
All right, I won't lie. I don't do that kind of thing. That is cray.
Crazy, I know.
All right, everybody. Yeah, we have lots more on this, and I'm sure we'll get back to it at some point. In the meantime, we want to get back to the markets, bouncing around here, down across the board on equities. We're heading over to our TV colleagues. That's because Beyond the Bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Shonali Bassick. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenevec in our radio booth as we welcome our audiences across all of our Bloomberg platforms. That includes radio, TV, our partnership with YouTube, Bloomberg Originals here on a day, well, Carol Masser, where we're seeing another decline here in the broader market. Still some concerns about valuation, still some concerns about how much is left in this rally.
Yeah, and a fair amount of concerns when it comes to what's NVIDIA going to say tomorrow when it reports, when we're still so excited about all things artificial intelligence. So you're seeing the stocks, when you look at it, some underperformance there based or compared to the other major equity averages. Right now, the stocks is down about 1.6%. And NVIDIA, I know, Tim, this is going to be one of your major decliners later, but it's really taking a big hit today.
Yeah, it is. We'll get to that in just a second. I want to take a step back.
Don't front run him, Carol.
I know.
Hey,
well,
that was a gift.
That's
It's a little bit of a tease.
It would have been kind of...
Got to keep people around.
It would have been a little nuts had I not chosen NVIDIA as my first decliner, right, guys?
Yes.
Okay, so Jimmy Lee, the founder and CEO over at the Wealth Consulting Group, we just spoke to him, and this is a guy who said all last year you should be buying stocks, don't have money in money markets. He said that was a fool's trade. He says the same thing this year. He says we're not going to see a recession. We're going to keep seeing the markets go higher. The Fed is going to cut rates this year. It's going to be a tailwind for risk assets, and it's a mistake to have cash on the sidelines right now. So he sees opportunities like this as buying opportunities, pullbacks like this, I should say.
We certainly are hearing the same thing from the likes of Hank Smith of Haverford, who is seeing even the likes of NVIDIA and other dividend payers like Meta pulling back and therefore becoming better candidates here to buy into because of those dividends.
All right, we get the closing bells here on this Tuesday afternoon. Remember, this is the first day of a holiday-shortened week. Back-to-back gains on the S&P 500, flipping, well, to back-to-back losses. And S&P 500 down about 30 points or 0.6% here at the close, back below that 5,000 level. The Dow Jones Industrial Average lower by 63 points or about 0.2%, while the NASDAQ Composite is going to finish lower by about 0.9%. That's down by about 145 points. But the big decliner on the day, that's the Russell 2000, a loss of about 1.5%.
All right, so let's get to the flip side, some individual gainers, if I may, in today's session. And you've got Discover Financial. We know the reasons why, right? Up just off its highs of the session, up almost 13% in today's trade. Capital One Financial, of course, that deal that Bloomberg broke to buy Discover Financial, $35 billion all-stock deal. It's going to create the largest U.S. credit card company by loan volume. So big deal, and no surprise as Discover being the target to see it really outperforming and rallying in a big way. Got to get to Walmart. Another story, some M&A action there as well. Walmart finishing the day with about a gain of about 3.25% off its highs, moving the most since 2022 of November, topping earnings estimates in the fourth quarter, also confirming reports that it is buying smart TV maker Vizio for about $2.3 billion. Walmart did put out softer guidance, but nonetheless, some outperformance. Should we get to some earnings?
Yeah, if you like earnings, Carol Massar,
I do.
You're going to get them right now. Caesars Entertainment crossing the wire here. Net revenue coming in the most recent quarter on a same-store basis, $2.83 billion. The street was looking for 2.85, so a modest miss here on the top line. As for the bottom line here, they had a 4Q loss per share of about 34 cents. Not quite sure what the comparison is on that here, but overall you're looking at about a 34 cents loss in the most recent quarter on $2.83 billion in revenue. EBITDA in the quarter, $930 million. The street was looking for 945.
A little more commentary on Caesars here. The Chief Executive Officer of Caesars, Tom Reeg, really citing here the progress being made in the digital business there. Really, of course, you're saying we are seeing a bit of a miss in total earnings. So management shifting you to look at those digital numbers here, a 78% increase to approximately $1 billion. Of course, all shifting online.
Yeah, look at that. Over $700 million improvement in this segment's adjusted EBITDA. Digital net revenues approximately $1.0 billion, Shonali.
Yeah, I also want to bring you some more earnings here coming in from Chesapeake as well, coming in after the bell. We're seeing adjusted earnings per share hit at a higher than estimated number at $1.31, $1.31. The estimate was 71 cents. Of course, the energy industry has been of high interest to investors in this era. Major deal-making moment for the industry here. We are seeing them beat estimates according to what Wall Street had projected for earnings per share.
Yeah, so seeing what a little bit of movement we saw in the aftermarket here when it comes to Chesapeake, just actually seeing it unchanged at this point. But, you know, the energy space, no pun intended, has been on fire a little bit in terms of some of the consolidation. But this one, year to date, too, just little changed, remained just up about 1% here.
Absolutely. And I mean, it's kind of come divorce, I think, from some of the moves that we've been seeing in actual energy prices themselves, and maybe for a good reason. And you mentioned all that M&A, of course, that has been on fire, as you just said, and maybe that does continue.
Yeah, to that point, Nick Dell'Osso, the president and CEO of Chesapeake, saying that the strategic combination with Southwestern will make our future outlook even stronger, extending America's energy reach by positioning us to deliver more reliable, affordable, lower carbon energy to markets in need. The company is also forming the first U.S. independent that can truly compete on a global scale. It says that it's going to redefine the natural gas producer to the benefit of shareholders and energy customers alike.
All right, just going back to Caesars, if we may, we're still waiting for some others. Keep in mind, too, about 4:30, we're going to get a read on the housing sector with Toll Brothers. But Caesars continuing to be under pressure here in the aftermarket, down about 3.4%. We broke down their earnings earlier of that fourth quarter same-store adjusted EBITDA. That was a slight miss, $930 million, 944.5. We talked about, increasingly for these companies, these gambling companies, the importance of digital, but nonetheless, we're seeing some disappointment here.
Well, the digital was doing great. I mean, I think it was up 28% in the most recent quarter. Unfortunately, that
not
makes
enough,
up
right?
a small percentage of their revenue. I think total revenue, it's only less than 10% or something like that.
Yeah, and it's interesting to the point you're making there. We have Las Vegas same-store revenue missing expectations according to MODL estimates that we're seeing on the Bloomberg terminal here. So the digital's not making up for those core markets.
I have a question, though. How do they find that balance? So, I mean, I was just out in Vegas, and I mean, obviously still a big destination for those folks who want to gamble. But you're reminded pretty quickly, just from all the ads out there, that I actually don't need to be there. I mean, if you have a telephone and you're in a state that allows it, I don't need to go to Vegas or Atlantic City or anywhere else.
You need to be there to see. You need to be there to see U2 at the Sphere. You need to be there to see Adele.
Yeah.
You need to be there to eat the food.
Okay.
And so I think that's a big part of it. To the digital side, though, I do think.
But is Adele there? I mean, I saw her at the weekend at the All-Star game, and apparently she doesn't like performing.
She was there a few months ago. I know. But
yeah, she was. I saw a big sign for her performing, but she wasn't actually singing.
You want to go to some other earnings that are out?
Palo Alto Networks, Carol Masser, is crossing the wire right now, so let's get right to it. Those shares moving lower by about 13% here in after-hours trading. In the most recent quarter, its fiscal second quarter, EPS came in at $1.46 a share. Revenue came in at $2 billion. Both of those were a beat. However, here's your guidance going forward. For the third quarter, fiscal third quarter, the company sees adjusted EPS at $1.24 to $1.26 and revenue at $1.95 to $1.98 billion. Both of those would be below what the street was looking for on average. For on a full year basis, the company says adjusted EPS $5.45 to $5.55 here, and full year revenue at $7.95 to $8 billion even. At the top end of that range, that's below the bottom end of the range that it had been given before.
Yeah, the full year numbers certainly coming in well below estimates. You're seeing the shares now drop between almost 12% and more than 12%, almost 13% after market, after reporting those figures. And to your point here, revenue softly above estimates, but not all forms of its revenue. Subscription and support revenue came in below estimates, and therefore you have to wonder about business spending in this environment, Romain.
We've seen, I'm sorry, Carol, go ahead, but we've seen this with some of the other cybersecurity companies here. And there's been a lot of talk as to the health of these companies and also the migration, the idea that a lot of people would rather just, say, deal with the Microsoft or deal with an Alphabet or deal with somebody and get sort of an all-in-one solution rather than having to farm it out to smaller companies.
It's also a company that's been up big time this year. It's up more than, 20%? I think it's up about 24% year to date. So maybe some really high expectations were built in. But if you look at that third quarter forecast, whether it's billings, whether it's adjusted EPS or it's revenue, I mean, they're really reining in the numbers and disappointing on all three fronts.
Yeah, and I'm not seeing that reflected at all in the commentary, at least in the press release at this point. The company's CEO and also chairman saying that the leadership goes across all three of the platforms and growing cross-platform adoption puts us in a strong and unique position. So no acknowledgement of the outlook that is coming in below estimates.
It'll be interesting to see how investors digest. Obviously, this is a knee-jerk reaction, but you're still talking about a company growing revenue at double-digit percentages here, both on the quarter and the year. And while that's below those 30, 40% growth rates that I think some people have gotten used to, I mean, 20% growth, which is what they had in the most recent quarter, that's pretty good.
And they say the buzzword right up high in their statement, of course. They're
AI or
focusing on their AI leadership strategy.
I was just going to say,
three buzzwords for you just at once.
Got it in there. They got it in there. But investors certainly not impressed here. Palo Alto down about 13% here in the aftermarket. All right, guys. I know we're getting to the tail end of earnings, but nonetheless, a fast and furious dump here.
Is there a big one tomorrow? Is there a big one tomorrow after the bell?
Perhaps.
Big one.
Okay. Yeah. NVIDIA.
We'll be on it. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Guys, we will see you again. We call it Beyond the Bell. We'll see you again, same time, same place, tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week, and I don't know if you had a chance to check out our weekend show over the long weekend, but Carol, we went all in on real estate. From design, resilience, and sustainability with the CEOs of Gensler to commercial, industrial, and multifamily with the CEO of Crow Holdings, to so-called alternative real assets such as storage and senior and student housing, with the CEO of Harrison Street. You can still catch our weekend show, by the way, on our podcast feed.
Yeah, good stuff, right? And there's a lot of questions when it comes to real estate. It's a great indicator, too, of what's going on in the overall economy. One thing, though, we didn't really do as deep a dive into, and that was REITs, real estate investment trusts. So we definitely wanted to tap into that. Laurel Duque is head of global listed real assets at Morgan Stanley Investment Management, and she's with us from New York City. Laurel, good to have you here with us. First, let's start big and wide. What are you seeing when it comes to the REIT environment? And it's hard because not every REIT is the same. So what's kind of a smart narrative as you look at the group overall?
So glad to be here. Thanks for having me. I do think that the REIT environment right now is very nuanced, as you had indicated. And a lot of the top-down macro is really centered around interest rates and the direction of interest rates and the market's expectation of the direction of interest rates. But when you look at the nuance, when you look at the idiosyncratic, there really are some very important secular drivers of demand that are propelling growth for a lot of these alternative asset classes that you were just referencing that are really impactful for the REIT sector.
Okay, what are those things?
So when you look at from more of a top-down perspective, technology and innovation is a theme that is really important in the broader equities market, and it is also very important for the real estate market. When you look at the data center market, it has been a growing piece of the overall REIT market for the past 20 years. And so when you're thinking about what's going on with artificial intelligence today, that is very impactful for the data center sector. It's a wildly overlooked but important beneficiary of AI and new technologies that have been evolving.
Yeah, one thing that's interesting about this now, Laurel, is, well, one thing that's interesting about this now is that, 4 years ago, we wouldn't have been talking about, Equinix in the context of AI. We would have been talking about it in terms of cloud storage. So talk to me a little bit about how that conversation has shifted. And Equinix, of course, is one of your picks, ticker EQIX.
Yeah, no, absolutely. So when you think about, there's been a bunch of different, what I would call transformational moments in time when thinking about computing and data and therefore data centers. So first it was just the rise of social media and how that created so much more data to be stored in these data centers around the globe. Then it was the rise of cloud computing and how the virtualization of the machine was so important for data centers. And now we're seeing AI, and the impact that AI is going to have on the space likely is going to be a game changer. Equinix, ticker EQIX, as you said, certainly is benefiting from that. But we are still in what I consider to be the infancy of demand stemming from artificial intelligence.
Yeah, it's interesting, right? And I think, here we thought last year was all about the excitement and hype, but feels like it's pulling or gaining even more momentum, Laurel, this year, right? It's not just going away. Like, we're realizing that there's, a lot to be learned and understanding in terms of AI impact, but it doesn't feel like it's going away here.
Yeah, no, absolutely. And when you think about the impact for data centers, the GPU is going to require a significantly higher power draw than the CPU within regular compute. And so that requires 2 to 4 times more power. And that therefore means 2 to 4 times more data center that we need for the same amount of actual data. And so this is something, again, that's transformational for the space, not only because of this incremental demand, but because of that incremental power draw that is required.
Hey, I want to go to DLR, Digital Realty, ticker DLR, another one of your picks. This one is a pure play data center owner. How does it differentiate from Equinix?
So Digital Realty, ticker DLR, really is pure play data center owner, operator, developer. They have the hyperscale focus. meaning that they are really looking to those large footprint tenants. They were a huge beneficiary of cloud computing. They will be a very big beneficiary of artificial intelligence. You saw the company report last week, and they actually reported some disappointing expectations with regard to earnings growth. But if you dig a little deeper and understand the nuance there, it's actually because they have been doing a lot with their capital stack in order to be able to right-size their balance sheet in order to be able to meet this AI demand and fund new development, and therefore be able to realize that growth in 25 and beyond. So Digital Realty is a company that has a refreshed management team. They have a new CEO, a new CFO. They have a new chairman of the board who is really making some tough decisions with regard to what needs to be done. As I said, they've right-sized their balance sheet. They have created new joint venture partnerships that really is providing them with ample access to capital to be able to develop into the bullseye of AI demands.
Hey, I want to broaden out the conversation a little bit and talk about one more of your picks. Carol, I know you were really interested in this one.
Well, Iron Mountain is an interesting
You see the
one.
trucks everywhere.
No, we do see it. And actually, they're not far. I believe one of their offices, their main office, is not far from where I live. So I see their trucks a lot.
You just drop off your paper and get it shredded there?
Exactly. No, I don't. But yeah, but there are people who do. I mean, this is, from high tech to low tech, if you will. But right, all of these data centers, there's a lot of paper that comes out. You got to do something with it. You don't want to just leave it laying around.
So Iron Mountain, ticker IRM, definitely another interesting one when thinking about the storage of data. And as you had mentioned, they have been the primary paper storage company across the globe. They are also a new entrant into data centers and digital storage. They've really evolved their business model to capitalize on their core competency and the relationships that they have with all of these businesses and enterprises around the globe in order to capture digital storage as well. So they've been building out data centers for the past several years. Right now, it only represents about 10% of their revenue. But it is a growing piece of their business, and they've built up this competency. They've built up this platform to be able to develop into this AI demand. Interestingly, when you look at it from a valuation perspective, this company is trading at about a 6 to 7 turn multiple discount versus those pure play data center companies that I was just talking about. And over the next couple of years, they're going to have very similar earnings growth. So this is the value play within the data center world.
Hey, Laurel, before we let you go, 30 seconds on the best way investors can have exposure to the aging population, those baby boomers who will move into senior living. 20 seconds here.
Yeah, so when you think about the aging population, the best way to play it is through ticker WELL, W-E-L-L, Welltower. They have about 70% of their earnings coming from seniors housing. Seniors housing is going to be a big beneficiary of the aging demographic. Over the next decade, we're going to have about 8 million more people enter the 80-plus-year-old age cohort versus only about 2 million incremental people that have been added over the past decade. So Welltower is one that's going to be able to benefit from this growing demand.
Come back soon. This is fun. Smart. Laurel Durkee, she's head of global listed real assets at Morgan Stanley Investment Management.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We're keeping an eye on Palo Alto Network shares after hours. The stock selling off big time, down now 13.3%. Palo Alto Networks is tumbling after cutting its revenue forecast for the year, sparking concerns that customers are reining in tech spending. The big event for investors tomorrow will likely be NVIDIA's report after the close of trading. Ahead of that report today, we did see NVIDIA shares decline by 4.3%. It was a down Tuesday as we kick off the new trading week. The Dow, the S&P, and NASDAQ all finished in the red. S&P today lower by 30 points, a decline of 0.6%. The Dow today down 64, drop there of 0.2%. NASDAQ, the composite index, down 144, a decline today of 0.9%. 10-year yield 4.27% with a 2-year 4.61%. Spot gold up little changed, but higher nonetheless, up 40 cents the ounce to 2024. West Texas Intermediate crude down 1.7%, 77.15 a barrel. So again, recapping after the close of trading, we did hear from Palo Alto Networks, the stock tumbling in late trading after cutting its revenue forecast for the year. Palo Alto Networks now down by 13.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Tim Stanovic, live here in our Bloomberg Interactive Brokers studio. Tim, safe to say, we hear it over and over again from the leaders of companies, their most important asset that they have are their workers. Their
Do you
employees.
believe that? It's like, okay, like,
I mean, what, versus their relationship with their banker?
Okay, how
or
important is
regulators?
it? How important is it that Disney has the rights to like all the Marvel stuff and
That's pretty important.
But also employees are important.
Yeah.
But okay.
I think it's fair. Like we go back and forth.
I think it's true. I do think it's true.
Until AI replaces us
Until
all.
they get laid off.
Until they get laid off. All right, well, the relationship employees have with their employers has definitely changed a lot in recent years. Our next guest argues that the, quote, normal ways of working are not coming back, so we cannot rely on what worked back then to work in the future.
We have with us Tabitha Scott. She's the author of a new book. It's out today. It's called Powering Change, the hidden resource to unleash potential, productivity, and profits. She joins us from Denver this afternoon. Tabitha, how are you?
Hey, I'm great. How are you today, Tim and Carol?
Yeah, we're doing well. Congratulations on the book. Okay, so I want to start big picture. How would you describe the current state of the typical American business, the ones that you work with as a consultant right now? Like, how would you describe their workforce and how their employees are doing?
Yeah, I think we have 3 key challenges in the workforce right now. One is the accelerated pace of change. You know, during the entire year 2000, the technological change now occurs every 30 seconds. And so we're distracted, we can't keep up, we're chasing change. The second thing is we're off balance. We're off balance because we feel disconnected. There is no new norm. It's more like chaos theory instead of linear math, and we're burnt out as a result. So all of those things tie together, and the further we get away from natural systems and science and the way the world works, the worse we're going to get.
What do you mean everything changes 30 seconds? Like, I agree things are fast and furious, but 30 seconds, that's a little extreme, don't you think? I mean, we see the trends.
It's true. It's so true. If you think about it, we have more computing power right now on our cell phones than NASA did when it landed a spacecraft on the moon. So
that's but we've grown into
compelling.
it, right? Like it's become, you know, we talked earlier about how all of this stuff has also helped make us much more productive and that might be a plus in terms of kind of reining in some of the inflationary pressure. So some of it's good.
Some of it is absolutely good. And the key thing there is to stop chasing change, like trying to follow every little rabbit that pops up. And instead, think about your current spot on the growth curve, on the growth cycle. Where is your company? And how do you sink into that and really do the things that you need to do to eke everything you can out of that phase of the cycle? In the past, companies would think about the whole growth cycle. Now you just need to think about where are you and which thing do you need to deploy right now to get the most out of your business.
Okay, so let's think about it from the perspective of folks who don't necessarily run businesses. When I talk to folks like you who work with businesses, there are also takeaways in what you write and what you do for just empowering individuals and helping individuals find, you know, more efficient ways of doing things. Give us a lesson that you would normally give a manager to somebody who isn't necessarily managing someone.
Yeah, absolutely. So the things that energize you, you will be more productive, engaged, innovative. And so that goes true whether you're talking about yourself or you're talking about the team that you're leading. Everybody places somewhere along the growth curve, for example. People at the beginning of it love taking risks. It's a challenge. People at the top are more like Sheldon from Big Bang Theory, don't mess with my stuff. Like they love finding risk and making it more efficient. So 90% of Purdue engineers, they fall into that category because they're great at refining and using existing frame of references. A lot of HR folks are in that category as well, very necessary. And then at the beginning, you have your Elon Musks, your people that are always creating new ideas like Steve Jobs was. And everywhere in between, if you're in the middle, you have execution. Now, the cool thing is you can tie that to cognitive diversity, and whether it's people or the way machines think. Carol, when we came on, you were talking about AI. AI is at the tip of the curve. Data management is in the middle. It takes inputs, turns it into action. And at the top, you have things like automation to refine. So the secret sauce is figure out, assess where you are on that curve, align it to your job, and then adapt with every project that comes up. Every sprint is a little bit different. You don't need the same team every time anymore.
You know, one of the things that I think about when we were talking on our planning call early this morning with our producer, Paul Brennan, is the idea of how you take lessons from physics, bioscience, and nature, and then kind of mix that in with organizational research. So to kind of get to what you put out in this book, Powering Change. Talk to me a little bit about physics and bioscience, what that teaches us in terms of maybe creating a better workforce or a better group of employees.
Yeah, so the growth curve that we were just talking about is one example of science or physics. If you take it on down the other side of the curve, you have a sine wave. And once you hop onto the next curve, as they teach in all your strategy courses, then you couple them together and it looks like a DNA helix over time. So if you boil down everything, and I mean everything, humans, animals, plants, and organizations, we're all made of energy and data at our core. That's it. It's that simple. So if you figure out how to tap into your energy, if you figure out what jazzes you up, and then you know how to produce, you'll be more innovative and you'll be more engaged. And the same as with organizations. If they really understand which phase of that life cycle they're in, is it birth, growth, maturity, like a cash cow, or decline, then they can understand how to plan ahead to the next step, as well as get as much juice out of what they can for the current phase.
Have you worked with companies that are in decline?
Absolutely. Absolutely.
How do you motivate them?
Well, they use things like all of the key business models that are out there, like human design or total quality management. They all fit on the growth curve somewhere. So if this is a decline phase client, then you're going to use something like human design or design thinking in order to leap onto the next curve, something creative. If you're working with a scaling company or a growing organization, that's when you're going to use things like Lean, Six Sigma, and you're going to streamline and make it more scalable.
I'm trying to figure out, because I feel like, to be fair, Tabitha, you know, we have a lot of guests on that I feel like we talk about how do you motivate workers? How do you do it? And Six Sigma, I think, you know, was certainly a powerful tool of Jack Welch and his disciples. I think some might be rethinking some of that. But I do wonder, in this environment where you have increasingly employees who want balance or the flexibility to work from home, you know, that doesn't necessarily always coincide with an employee's or employer's goals. Like, what's the right conversation around that?
Yeah, there's a number of ways that you can look at that. Knowing that at the core of that person is energy, what is the thing that energizes them and how can they do more of it? Maybe they're not able to work at home every day, but can you give them one day a week? Maybe they're not able to stay in an office a whole day. So maybe you gamify it by saying, okay, at lunch, you get to go outside and go for a walk. Whatever it is that person enjoys, and you can find it for yourself. If you love mentoring, try to do more of that. If you love dark chocolate, you know, if you get all your reports done, have some dark chocolate. It sounds silly, but as long as you have something that brings your vibe up, because we're made of energy, you'll be more productive and more engaged.
You got my attention when you say chocolate. Tabitha, really appreciate your time. Tabitha Scott, Tabitha Scott. She's the author of a new book. It's out today, Powering Change, the Hidden Resource to Unleash Potential, Productivity, and Profits, joining us from Denver.
Watching shares of Toll Brothers, Carol, you mentioned that the shares right now are higher by 0.9% in the aftermarket. First quarter adjusted home sales gross margin came in above estimates at 28.9%. Estimates were for 27.9%. First quarter backlog also came in above estimates at 66.93. Estimates were for 66.74. And now to the second quarter, the company sees second quarter deliveries 2,400 to 2,500. That's in line with estimates. We're at 2,494.
Yeah, so bottom line, they're boosting their adjusted home sales gross margin guidance for the full year. The guidance beat the average analyst estimate. Tim, you were walking through some of those numbers. Adjusted home sales gross margin of 28%. They had seen 27.9%. The estimate was 27.7%. So beating that, they're seeing deliveries of 10,000 to 10,500. They had seen 9,850 to 10,350.
So just kind of narrowing the guidance a little bit,
Yeah,
right?
but upping the range a little bit too. And also seeing SG&A expenses as percentage of home sales revenue, 9.8%. They had seen a little bit above that at 9.9%. And the estimate was 9.8%. So continuing to watch them. Just, you know, another indicator of what's going on. They're high-end real estate, and the stock just up a little bit in the aftermarket, as you said, Tim, just up about 0.8%. Stock's a little changed on the year, just up about 0.7%.
Were you here when Lyft came out with that big error?
Yeah.
Okay.
Yeah.
So you got to wait for the next day sometimes to, confirm the numbers, right? That's the lesson.
Got to keep a close eye on it. All right, everybody, let's get to world and national news. After DC, we go with Nancy Lyons. Hey, Nance, take it away.
Hey, Carol. The Biden administration plans to impose new sanctions on Russia this Friday for the death of Russian opposition leader Alexei Navalny. National Security Advisor Jake Sullivan says it will cover a range of elements in Russia's defense industrial base.
We have worked persistently and diligently to identify, to continue to impose costs for what Russia has done, for what it's done to Navalny, for what it's done to Ukraine, and for the threat that it represents to international peace and security.
Sullivan says what he calls the weakness and rot at the heart of the system Vladimir Putin has put in place is only confirmed by Navalny's death and the arrests of hundreds who mourned his passing. Former South Carolina Governor Nikki Haley says she plans to stay in the presidential race.
I refuse to quit. South Carolina will vote on Saturday, but on Sunday, I'll still be running for president. I'm not going anywhere.
During her speech today at Clemson University, Haley said she intends to compete until at least Super Tuesday, March 5th, when more than a dozen states hold their primaries. Additional charges are being filed in connection with the shooting at the Kansas City Chiefs Super Bowl victory parade. Jackson County prosecutor Gene Peters Baker says 2 adults have now been charged with murder.
We seek to hold every shooter accountable for their actions on that day. Every single one.
Peters Baker says this is in addition to 2 juveniles who were arrested on gun-related charges. 1 person died in the shooting, 22 others were injured. The College Football Playoff Board of Managers is approving a model for the new 12-team playoff. The new model guarantees the 5 highest-ranked conference champions will be included in the expanded playoff this fall. The next 7 highest-ranked teams will fill out the rest of the bracket. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story headline right off the Bloomberg Professional Service. Citigroup is lifting CEO Jane Fraser's pay about 6% to $26 million for a year, in which she kicked off a major overhaul of the Wall Street giant to simplify operations and boost profitability. Again, Citigroup lifting CEO Jane Fraser's pay by about 6% to $26 million a year. After hours, Palo Alto Network shares selling off. We've got the stock now down by 14.3% after earnings. Also after hours, we did hear from Toll Brothers. Toll is boosting its delivery forecast for the full year. The home builder reported first quarter revenue of $1.95 billion. Estimates were for $1.87 billion. After hours, we've got the stock jumping. Toll Brothers now higher by 4.01%. Stocks move lower across the board today, with the Dow, the S&P, and NASDAQ all declining as we kick off the new trading week. We've got the S&P 500 index down 30, a drop today of 0.6%. The Dow down 64, lower by 0.2%. NASDAQ down 139, drop there of 0.8%. Wall Street, of course, eagerly awaiting NVIDIA's earnings tomorrow for confirmation that the stock can meet sky-high expectations. Today we had shares of NVIDIA declining. NVIDIA today was down by 4.35%. Tomorrow's going to be a very busy day. You got to keep it locked into Bloomberg Radio because we got the Fed minutes tomorrow, NVIDIA earnings. As for those Fed minutes and the interest rate outlook, Jimmy Lee is CEO at Wealth Consulting Group, and he was a guest right here on Bloomberg Business Week.
I really don't think we're going to get any rate increases, and I do believe that the Fed is going to be a tailwind for risk assets such as stocks or equities and even real estate this year. So I think at the end of the day, when we look back at this year, I think you're going to see the Fed being a friend, not a foe.
And you can hear more of the conversation with Jimmy Lee of Wealth Consulting right here on the Bloomberg Business Week podcast. Again, recapping Palo Alto Networks selling off after hours. The stock now down by 14.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, this story really popped out for Tim and me today. If you are among the 56% of U.S. workers with a retirement plan, our next guest has some bad news for you. Your 401k will be gone in 10 years, tops.
Okay, not the money she writes.
No.
Before you get all freaked out. She does point out that Americans have trillions of dollars in these accounts, and there's an entire industry built around them. But the plans themselves. We're talking about Allison Schrager. She's Bloomberg opinion columnist, also a senior fellow at the Manhattan Institute. She's also the author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. She joins us from New York City. So Allison, I had no idea until reading your column that 401ks were so contentious. It's like one thing that Democrats and Republicans agree on is that 401ks are not so good for the U.S. Explain.
Well, I mean, to be honest, there's about a community of about 12 pension economists who really get into this, and there's just becoming a wider sort of agreement amongst those 12. So maybe that's why no one's heard of it. Because most people.
So it's not just me.
Yeah, no, it's inner pension geek discussions.
Okay.
But I caught my eye of both Andy Biggs and Alicia Mundell. Normally within those 12 people on completely opposite sides. You know, Alicia does not like 401k plan, like defined contribution plans at all. Andrew loves them, but they're both like this. Both can agree that the tax treatment is expensive and it doesn't induce people to save anyway. So, I mean, this is how it starts. You get this intellectual movement, and with the money that the federal government's going to need, and they don't want to increase taxes directly on people, this is just going to be a popular target.
Help me, though. I thought everybody was like, 401k, that's going to make you save. You got to take advantage of it at your employer. Why are you saying that it doesn't really make people save?
Well, it started with this Danish study, and it's been replicated in a lot of other countries, including the U.S., that the tax treatment really doesn't induce people to save more or like up their savings rate. Sometimes it just gets you to save more in a 401k account and then save less in other accounts. What does have a big impact is the automatic deduction and the automatic enrollment. But the actual tax treatment doesn't seem to motivate people at all, which is one of the reasons why I suspect people won't miss it that much when it's gone.
Okay, talk to us about the cost of a 401k. And I'm not talking about the cost to Americans in terms of how they're being tax advantaged. Contributions to a traditional 401k are not taxed. And there is a loser when it comes to that, and that's Uncle Sam, and that's what the issue is.
Yeah, well, tax deferred. So you put money in it now and you don't pay tax, but you do pay tax when you retire. So whether or not you face a higher tax rate then, which particularly if you're high income, you probably will because you're, have less income when you're old. And also you don't have to pay the capital gains taxes. And that's estimated to be almost 1% of GDP in lost tax revenue.
Okay, that's quite a bit. But what I would say is that you're still getting the tax revenue on the other side. It's just deferred. So how much? Okay, go ahead.
And that's one reason I kind of am not willing to sell them out entirely.
Okay.
One, I do think, well, they do induce, maybe don't have a big impact on the amount you decide to contribute. I do think they keep money in that account, and that has a lot of value, clearly, because, we're worried people will spend the money. And also, it's sort of forced savings in a way for the government, and we don't really do that in any other way, because they're foregoing tax revenue now, but we'll get it in the future. And that's pretty much the only way the government's saving at all. And, that's not nothing.
All right. In a world, as you know really well, Allison, where increasingly companies aren't offering pensions or other types of retirement plans, and we keep still having, concerns about Social Security, that is not certainly a living retirement. The amount of money that, we continue to be worried that there's not going to be enough for everybody. So what's going to happen? Are employers just going to get rid of their 401k plans? You say no.
Well, they'll probably still offer it. I think there's going to be, and if they offer, a contribution to it, then that will be an incentive to stick with it. But you think if this contribution is not tax advantage either, wouldn't people just prefer their employer just give them the cash if there's no tax advantage? And so that's why I see it sort of eroding to eventually accounts that are more liquid. There's already a movement to have employers automatically deduct people's money and put them in more liquid accounts for emergencies. So it's so you can see how the ball is rolling of people just, why would they bother putting their money in an account that have no tax advantages and has a penalty? And, especially if the employer's on board on this, you just don't see the point anymore.
All right, but I feel like my mother's leaning over my shoulder, but it's great that you can't touch it. And there is something to that, or that you're penalized in a big way, because if we're all going to be ultimately, or a majority of us, responsible for our retirement, you gotta, you got somebody that's got to kind of play hardball with us and being like, don't touch it.
Well, I guess whether or not that's true is whether or not you think people are saving too much or too little for retirement because of some behavioral deficiency. If we're just need things now but regret it later, then you can justify that penalty and we need it. But if you could argue, hey, maybe people just want to live in the now for rational reasons, and they'll just deal with poverty in their old age, and they're okay with that.
YOLO comes to mind when you say that. Hey, what about the Roth 401k? That in recent years has seems to have increased in popularity in terms of employers, just anecdotally offering it. This is the idea of a 401k that you put money into after you pay the taxes on it, and then you don't have to pay taxes on the gains when you pull it out later. What about a product like that?
Well, we see them becoming much more popular. And I mentioned a study in Canada that found that they've become a lot more popular because you can also take the money out without a penalty. And people do seem to enjoy the liquidity with that. So, that's also an option. I've noticed in the comments and the emails I've gotten, people are skeptical that that the government will fulfill this promise and not charge them capital gains taxes. But so far, I'm a big fan of them personally.
So what's your advice to somebody who's young and starting out, and maybe with the idea that, 401ks, they might be offered it now, but not in the future? What's your advice? Just got 30 seconds here.
Well, there's nothing wrong with putting the money in now. You're not going to lose that money. You just might not be able to count on the tax benefit in the future.
Interesting stuff. Just another thing for us to worry about.
I'm not going to worry about this one.
Not for now.
No, I have my list of
FOMO,
worries.
YOLO, what is it?
Yeah, YOLO.
YOLO. Alison Schrager, great read. Definitely caught our attention. She is Bloomberg opinion columnist, senior fellow at the Manhattan Institute, with really something that so many people just take it for granted, right? To just use it.
Yeah, but I think maybe the traditional 401k as we know it will be gone, but there will still be some sort of other tool in place to help you save for retirement, because
I think the government should just give you a lump sum when you're born, and
that's an experiment that's happening.
Yeah, I just think that makes sense. She also is author of the book An Economist Walks into a Brothel, which is something you should definitely check out. This is Bloomberg Radio.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Palo Alto Network shares selling off big time after hours. The stock taking another leg lower right now. Palo Alto after earnings down now by 17.5%. It is tumbling after cutting its revenue forecast for the year, sparking concerns that customers are reining in tech spending. Again, after hours, Palo Alto Networks now down by 17.5%. Sources tell Bloomberg the FTC and a group of states are poised to sue as soon as next week to block the tie-up between supermarket giants Kroger and Albertsons. The suit is expected before February 28th, when an agreement not to close the deal between the companies and the FTC expires. Macy's says it has received 9 nominations to its board from Arkhouse Management, the activist investor leading an effort to acquire the department store company. Walmart topped earnings estimates in the fourth quarter. Shares did advance today. Joe Feldman is an assistant director of research at Telsey Advisory.
I do think that, Walmart has been doing very, very well. They certainly seem like they won the holiday season, and the consumer has been trading down. I mean, we do continue to see that, and I think Walmart's strength reflects some of that. It doesn't mean it's all bad for the consumer out there. I do think that the consumer is choiceful, as Walmart said, and it has been able to spend where needed.
And Walmart shares, they're up now by 3.2%. Separately, Walmart announced it has agreed to buy smart TV maker Vizio Holding Corp for about $2.3 billion. Also out with earnings this morning, Home Depot shares did advance, up by less than 0.1%. Home Depot did report a 5th consecutive decline in revenue. And those are our top company stories at this hour. And this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. That was Charlie Pellet. That's Carol Masser. I'm Tim Stenevec. We're in New York City. Let's get a check on the latest world and national news. For that, we go to Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. President Biden says he does plan on taking additional steps to sanction Russia for the death of opposition leader Alexei Navalny.
I told you we'd be announcing sanctions on Russia. We'll have a major package announced on Friday.
Issuing the sanctions on Friday coincides with the 2-year anniversary of Russia's invasion of Ukraine. Biden has already said he holds Russian President Vladimir Putin responsible for Navalny's death. Elon Musk's X platform says it mistakenly suspended the account of Alexei Navalny's widow, Yulia. The account briefly went offline when Yulia Navalnaya posted this video.
Мы знаем, из-за чего конкретно Путин убил Алексея 3 дня.
She's promising to take over her husband's role as opposition leader. X says the account was mistakenly flagged for violating its rules, and as soon as it learned of the error, the account was restored. President Biden's brother will be testifying before lawmakers tomorrow as part of the Republican-led impeachment inquiry into the president. James Biden is scheduled to sit down for a deposition with members of the House Oversight Committee. The interview is likely to focus on 2 loans President Biden made to his brother, as well as other business deals James Biden secured alongside his nephew Hunter, who is scheduled to testify February 28th. 2 adult men are now in custody, charged in the fatal shooting following Kansas City's Super Bowl victory celebration earlier this month. 2 juveniles had been charged following the shooting. Now Dominic Miller and Lyndall Mays are each facing murder and weapons charges. Prosecutor Jean Peters Baker with more on what happened.
Mays pulled his handgun first. Almost immediately, others pulled their firearms. Defendant Miller was one of those individuals.
Jean Peters Baker says they will hold everyone responsible if they were involved. 1 person died, 22 others were injured. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Carol and Tim.
All right, Nancy Lyons, thank you so much. We're getting ready to wrap up here on this Tuesday. But before we go, this story has crept its way among our most read on the Bloomberg. And of course, yes, folks, it has to do with NVIDIA.
Yeah, NVIDIA investors may have almost $200 billion in market value riding on tomorrow's earnings report. This is according to Options Positioning. Prices for short-term calls and puts imply a 10.6% move in the chipmaker shares on Thursday. That's the session after its earnings report, according to data compiled by Bloomberg. So, Carol, that would sway NVIDIA's market cap by some $180 billion.
It's a bit of a swing.
One of the largest single-session moves on record, still trailing records set by Meta Platforms, which holds both the biggest one-day drop and largest single-session gain.
Yeah, interesting. Now, keep in mind, NVIDIA is up 40% so far this year. We're talking about a market cap now of $1.7 trillion, so a little hefty. But traders are definitely bracing for a bunch more volatility. The stock has tripled in the past year, pumped by, the unrelenting artificial intelligence frenzy that has really propelled broader markets overall. NVIDIA is the S&P 500's top-performing stock year-to-date. You mentioned that earlier. And the biggest tech firms have contributed some 30% of the index's gains this year, so a big swing would likely ripple across the major benchmark. Right, we talked about the outperformance. It was the #1 performer last year, and it's once again there. So any major disappointment or upside surprise, we're going to see it in the market.
We are, and it's not just NVIDIA that's reporting tomorrow.
What else do we got?
We got Rivian.
Oh, Rivian.
After market.
Rivian.
We got Wingstop before market. We got Etsy after the market. We got Lucid, Synapsis.
Apples to apples there, huh, bud?
Yeah, Wingstop. Wings to wings. Hey, chips and wings.
Chips and wings.
Okay.
Now I'm hungry. Are you hungry?
Always.
Always hungry. The banana doesn't cut it. Anyway, we'll be breaking down NVIDIA with our TV colleagues after the closing bell, doing a lot of analysis. It's an important one. We're having some fun, but we know it's an important one. And as Abigail Doolittle said earlier, what it might mean in terms of sentiment is a big deal.
I love what she said. She said, you don't want to be the person who doesn't have a seat